Ladies and gentlemen of the crypto space, we're live on Wednesday, August 23rd at 11:34 a.m. Title of the stream is The Recycling is Changing. And this is a topic we've been talking about over the years, and it's the notion of a currency or characteristics of an asset some of these instruments have nowadays, but obviously the historical conversation is surrounding the United States dollar and the future versions of those dollars, which are debt instruments, collateral, U.S. treasuries. Now, they're obviously more so an asset maybe than a currency, but they are a currency because they're a future form of dollars. So the point is the supply increases every time fiscal says, hey, Treasury, we need some capital. Treasury does its auctions and increases Treasury supply. And, obviously 2023 is an interesting year, particularly because of the amount of debt that rolled over. And fresh issuance was used to pay that debt, and that receives a fair amount of criticism because we're paying debt with fresh debt, but people buy the debt. So all the debt that was issued by Treasury was bought this year. So far, there's been no central bank. The Fed has not been buying anything from circulating supply and hasn't been buying from Treasury issuance. Maybe a little bit of what has been maturing on the Fed balance sheet has been bought, but nothing to a significant extent, influencing the structure of the collateral flows through the system. Net quantitative tightening, as they define it, separate topic, QEQT unto itself. But we'll start off by looking at what Luke said, and this plays into us coming back to crypto markets, and we'll try and tell somewhat of a cohesive story. So back in the day, 85 to 2002, 28% of U.S. Treasury issuance was bought by literally just foreign central banks. So we're talking about sovereign nations. We're not talking about corporations or private individuals at this point. And then from 2002 to 14, 53% was bought. Obviously, there's a component to those percentages that was bought by corporations and the general public of varying countries, for instance. And then from 2014 to present, zero was bought by foreign central banks. So, you know, the best way to understand this is what we talk about in crypto markets is if you're increasing the circulating supply, if you're emitting and incentivizing, such as we see with these couple of federations that have emerged, you need to remove them from circulating supply. Otherwise, you have inflation. You have currency inflation, and that will drive down the price of that currency. Debasement. These are very complicated flows, and it's not easy to say that currency inflation is necessarily a bad thing, especially when you have demand. And in fact, that's the primary property of elastic currency that I find most appealing. If you have excess demand, that drives up the price of something. And the whole point of currency is you don't want the price of it to go up nor down. You want a relatively stable currency value, and that's not so simple. So, but the point is, when you have recyclers, when you have foreign central banks buying, you are disrupting circulating supply. So you are preventing excess appreciation of these instruments. And obviously, we can't directly, define explain the depreciation of curve in that regard. They're not buying enough, but that's because of market conditions, so on and so forth. There's a lot of components to the equation why we've seen the price depreciation that we have, particularly, most importantly, the size of the market. It's a micro, basically zero size market. But we see the same mechanics in play, and that's what's most fascinating. And from a macro perspective, we try and gain insight into what's occurring. It's not even like what we're speculating to be occurring. There's direct analogy to what's occurring in the crypto markets. We're seeing this type of recycling, this sterilization, this accumulation, this hoarding in reserve. And we also see nuances, differences, because these instruments are locked. It's not like the instruments that central banks have bought are locked. They can literally liquidate them at any time, but there's a locking component in these crypto markets. And that locking component, I argue, significantly changes the behavioral incentives to consider. And I think it's one of the biggest innovations because once it's locked, it's deterministically locked, which means anyone viewing these systems from the outside understands and knows that these assets that are locked cannot be sold. It's not like folks are trying to speculate in the price of 10-year, 30-year treasuries, and they're like, oh, what happens if foreign central banks dump? They're not locked on central bank balance sheets. They can be liquidated based on geopolitical complexities and respective domestic considerations. So the equations are very different for these two types of markets. We see the analogies, and one of the more interesting things is it's important to remind folks the structure of macro is changing. For 41 years, we had excessive demand driving the price of U.S. Treasury instruments up, up, and up. But that's no longer the case. I mean, the structure is broken, and the incentives for BRICS nations compared to the G7 to do what they're doing, everything is going to be different into the future. So what's important to understand is time horizon. We've been discussing that of late also, to have reasonable expectations over reasonable time horizons. And the time horizons for these types of changes is 10, 20, 30 is decades. But it's imperative to understand or try and assess what the directionality change means. And we can see that here. You see that clear as day in the chart if we go out to the yearly. Mind that white line. But I mean, literally, you broke through the TWAP. We haven't touched this time-weighted average price since the 80s. So, and you can see that cyclicality. And I love looking at like the TWAP without price action. Like this chart tells a hell of a story unto itself. Let's clean that up. Let's turn off the SMAs. Oh, look at that. I mean, come on. We haven't seen a green TWAP since 1985. That's it. And obviously this is 39 years because it takes time for the TWAP to start moving, especially on a yearly time frame. But the structure of the system is changing from clear as day in the data. So what does this mean? This is what Luke Groban talks about with regard to fiscal dominance. We see it in the amount of issuance this year. We see it in the amount of supply from like an M2 perspective. I have M2 somewhere. M2 expansion. This is just domestic United States. It's gone relatively parabolic and it's leveled off. I expect this to go higher. And we expect the central banks of other countries to go higher. So the value of currency is complicated, particularly because it's a relative phenomena, meaning just because you're increasing supply of currency doesn't mean means a lot with regard to price, particularly because price is relative. So if the United States increases supply 10% and on average other countries increase supply 10%, the relative price of the currencies are going to be unchanged. I hope you see that relationship. So that's why I talk about this chart in terms of geopolitical collusion. This is basically a chart of relative central bank monetary policy as well as fiscal. So isn't that fascinating? So that demystifies why currencies have changing values one way or another, because it's not changing necessarily or almost at this point because of organic pressures. It's changing because of geopolitical efforts and strategic sovereign positioning. So in the short term, we see the directionality, we see the shift occurring, but we also see the currency destructive pressures on the horizon. And we'll see what kind of intervention mechanisms are executed to mute volatility. We'll come back to more of our recent talks about where we're heading from here, because that's what really everyone wants to know. And literally, the United States bailed out the U.S. banking system this year. If those banks failed in March, the whole system would have been a cascade. It would have been a catastrophe. It would have been, inklings of 2008. And that was this year, right? That was a bank failure. The banks failed. In the last 100 years, if you said bank failure, it was front page news and contagion and economic catastrophe. But they papered over it on a Friday. On a Friday into a Sunday, they had a solution. So the last time they did something like this was 2019 in September, when the Fed, with the reverse repo, papered over with the repo, they papered over the repo markets. And that would have been bank failure as well. The banks weren't lending to one another. The banking system failed in September of 2019. Conversation about the true cause of 2020 is another story. We don't need to get conspiratorial at this point, but they contained that as well. Sometimes the containment takes a month, and we could see that in S&P, for instance. Go out to the monthly. So when you put things in the context and you see these charts, you're like, oh. So 2019 or 2020 was contained in a month. All that insanity that you saw in 2019, you could pretty much neglect this giant wick down, and it was a dip, 32 to 25, 700 points. Nice dip. It's basically what we've seen thus far, and that's neglecting the wick, of course. So they muted the volatility pretty damn well in March of 2020. So maybe the exercise we're all trying to do is acclimate to this volatility. Especially, we have to do that from a crypto market perspective where we see 70, 80, 90% drawdowns. But if you're able to handle this volatility, you're able to navigate and survive into future cycles. And as you can see, time and time again, future cycles are where you want to get to. And look at the time horizon between future cycles, the muting of volatility, producing a return. It took a fair amount of years back in 07, 08. So you got a high in April of 2010. That was a year and a half after it broke through that level, as you can see by the crosshairs right there. And if you go from the top, January 08, you didn't get back there until 5 years later. So it took 5 years to recover the price point. But look at the dips here. Look how well they've been muting volatility and managing this systemic headwind change. The change of the winds, the change of the season, the invalidation of recent historical structure, where the rest of the world finance U.S. domestic fiscal expenditures. The interesting topic is, deficit or surplus. And the world over the last decades financed our fiscal spending because we ran a deficit and we exported these currency units and we had globalization, so we were purchasing all of these goods and services from overseas, and all this capital was flowing out, and the rest of the world used it. That's changing, but that process, that concept, we've seen the analogy with these federations in the crypto markets, and that's maybe this chicken and the egg. Did I gain insight of macro and that macro phenomena from crypto, or did I understand crypto because of that historic macro phenomena? But in any case, the comparison is there, and we see that. And look how well Curve has held up. Now, a lot of folks would argue that that's not necessarily the case because they see price point. But I see distribution of vested interest. It was all bought. It's not going down. It's not a 10 cent, 1 cent, a half a cent. And so what does this mean? This means that the currency units that are being exported, which is comparable to the incentives, the emissions on the LP positions, are being consumed. They're not entering circulating supply. There's more purchasing than liquidation. Now, obviously, it's easy to get overwhelmed with depreciation. but that's not necessarily the biggest takeaway from this because we're not, anyone who's been here, we're talking about cash flow from vote rentals. Why are people renting votes? So they don't have to buy it, so they can vote themselves. And other protocols stepping in to be recyclers to consume that excess supply has stabilized the price. Look at the price. As much as we see this volatility to the upside up to 688 at peak, it's a stable price down here at 50 cents compared to January of 21. Ignore the move to the upside, and clearly it's painful if you bought it at an overpriced valuation, but it's not down relative to historic lows. It didn't even break the short attack in November of 22. Or maybe the short attack was this year, and that was June. I got to zoom in a little bit. Let's look in the weekly. Yeah, short attack was here. No, it was November of 22. Or maybe it was here in June of 23. Whatever the case may be, I like the way this chart looks because it's not down relative to historic lows. And the reason that's more meaningful as compared to like looking at Chainlink or XRP where they flatline. I don't have any charts. Uh, this is an increasing supply currency, asset slash currency. And that type of monetary policy not going straight down, that's why this level is meaningful. Anywho, move looks like shit, but let's take a look real quick at the moving averages. You'll see what I see. The 50 SMA. So we have a lot of volatility right now. So we're not going to have a relatively stable liquidity condition around the world. And that's what this chart indicates. That's what Mike Howell observes. The liquidity is under pressure from what is occurring in China and the Japanese fiscal situation. So I don't expect any stable liquidity condition in the short term. In fact, if anything, I expect contractions or pressures that have a significant capacity to contract liquidity conditions in the short term. So we could very much see chop for another 6 months. We could see a fair amount of depreciation, slow grind down, crab market for another 6 months. We'll see it in the data. We'll see it when liquidity conditions start to improve. You'll see move come down to less than the 100 SMA in the weekly, less than 100. Start to see move at less than 100. But historically, what you want to see is the move below the TWAP. And that's why we're actually quite very interesting here on the monthly, because it's been this incredible rounding top. The last time we saw anything like this was the '08 period. 2020 was an anomaly in many regards. Self-inflicted, many would argue. But inspecting this chart, we have to have decent time horizon. We're looking on the monthly, and we see basically a rejection. We see basically a breakout above the TWAP, which is this green to red line right here, where my cursor is, my pointer is. We see the breakdown, invalidation, breakout to the upside, but look at the wicks. Pressure to the downside, break down, and now we see resistance to the upside. So basically this is a topping pattern. And at some point this will fall down below the TWAP, and you start to see the TWAP come down. On the monthly, the TWAP, you're talking 6-month intervals to really see the destination, which is why check back Q1 2024, summer of 2024, and you'll start to see the TWAP trend down. You'll start to see volatility in the bond market trend down. Maybe the Fed does some QE at some point if they need to mute volatility, because that's an absolute requirement. And Treasury will yell at them saying, guys, you got to mute volatility a little bit because you have to maintain liquidity in the Treasury market. Treasury will certainly argue that. And as this starts to come down, volatility starts to edge down, 110 on average, goes down to the upper 90s to 110, and it starts to range in this area right here. Break down. That's when you'll start to see liquidity conditions significantly improve around the world. This is a leading indicator. So you'll see a breakdown first, and then it's checked back in a month or two, a quarter, 3 months, or the half, the 6 month time interval. That's when you'll see risk assets start to catch a bid because there's extra liquidity in the system. What the hell are people going to do with the liquidity other than buy shit? Because that's what they do. This is probably one of the most meaningful leading indicators, but it's leading on the quarter and on the half, 3 month and 6 month time frame. So when you see this breakdown, you'll see conditions improve in 3 to 6 months, give or take. So what takeaways could I offer? Changing of the system. Biggest takeaway is time horizon. This is it's not about bottom and price point. That's why liquidity and observing the potential capital on the sidelines, liquidity that can purchase, gives you an insight of where things are heading. This is where I want to be right now. I want to be where the liquidity conditions are poor because when the liquidity conditions start to improve, that's what I want to see. And we all very much look forward to that time. That's like getting in the markets in February, March of 2020, and the liquidity conditions artificially improved, obviously, or 16 and 17. Where's 16 and 17 on this chart on the dollar? Let's zoom in on the weekly. Where's the TWAP? Right here. The breach, so 16 was here. Look at the breach below the TWAP. Here's your 16 and 17 bull market in the crypto space right here. January of 16, we breached the dollar to the downside, and you see this move on the TWAP. Here, I'll draw it. You see that move right there in the TWAP? That's your crypto bull market in 16, and then 17 was just fire because that was and this was your dip in 17, and 16 leading into 17, and then 17 just ripped to the upside. And the momentum started to slow down. You had a breach to the upside, the TWAP, and final invalidation down here in 18. And everyone knows there goes the market flip in 18. 18 and 19 were boredom, and look at it right above the TWAP. So between the move indicator and the DXY, it just screams. Literally just historic conditions, but now the entire system is so sensitive to liquidity, collateral volatility, and obviously the currency markets. So we will see the flip in these charts. Let's zoom out. So where are we with the TWAP? There was your the increased liquidity conditions are when you to the downside. So there was a bit of the bounce in 23, right? 2023, we had a bit of a stabilization because 22, obviously that was just pure depreciation. We had a bit of the bounce as we broke to the downside of the TWAP, and now we've been hovering. So this is why we looked at China and Japan because this chart gives us a sense of the influence that particularly Japan and the Eurozone, but Europe has relatively stabilized its complexities there. There could be deflationary pressures as if Treasury yields continue to go up. Watch the rate of change on Treasury yields for Europe. But China, they're a very internal, closed off economy, and that bleeds over to the rest of the world. We'll see where this goes. That's why we've been talking about that 103 number. And look where we are on that 103 number. Isn't that quite remarkable? Let's go to the daily. I wanted to show you something. Here, check this out. So obviously we had literally a Pico top March 2020, 103.036. But look at these candles right here. Look at this interaction right here. Look how many interactions with the 103. It's quite fascinating to see. In June, June was a relatively stable month because folks were like, oh, it broke down from the 103 line. So maybe geopolitics would stabilize for a little bit and international liquidity conditions would improve. So this chart, when this goes down, the dollar's depreciating versus yen, everything. If this chart goes down, dollar's depreciating versus basically everything. You might have some micro one-offs with one currency or another, but generally, as the dollar is cheaper, you could buy more dollars with British pounds. Therefore, the pound is more purchasing power, it's more valuable, which plays into asset price inflation very obviously. If you could buy more things with pounds and yen and pick a currency, uh, they're going to do more things with their currency and buy more things. And that's exactly where we are. We're at a point where we broke above, look at this, the daily 200 SMA, but if you zoom out, and that's what's most important, still above below the 10 SMA and significantly below the TWAP. So you really need to see this unambiguously or peer through the bullshit, hide everything, and look at the time weighted average price. It's a nice rounding top. So the monthly gives you a decent perspective. The better perspective is the 6-month chart. It popped green again. It popped red, popped green. This is why time horizon is the hardest thing to grasp in capital management. You got to check back in 6 months. Check back in 6 months. You need another candle. You got to see this start to turn red. And this is why summer, you need two candles. We're on a 6-month chart, so it's literally just two candles. So you need two candles to show, to further confirm validation of this massive shooting star, and it'll push back down towards the TWAP. That's how far extended off the TWAP we are. Quite remarkable. The only time we got extended like this was back in 2000. 2008 was another story. Completely different stories from a global currency perspective, as you can see here. It's very obvious. We were literally in a downtrend, dollar depreciation during 2008. And we had a big wick up to the TWAP, which was rejected. If crypto markets were like the way they are back in 2008, that would be a very interesting time to see the price action. Well, my expectation is heading past 2020, summer 2024, is this finally breaks to the downside. Because if they want this currency regime to continue, it needs to break to the downside. It's exactly what Luke Roman says. No one's going to buy the long end of the Treasury curve, 10 years plus, as long as the dollar is this strong, because their purchasing power is so weak and all the countries are constantly needing to protect their currency. And how do you protect the currency? You sell your savings. You sell your treasuries that the country has in their bank account. You sell them for dollars and then you buy your currency. So that's how they're protecting their currencies. And that's the concern about the yen carry trade unwind. That's another story. But if the collusion between sovereign nations, they convince the United States to depreciate the dollar via whatever means. They probably won't say it, that it's artificial, but that's what has to be done if they want this regime to continue. If the U.S. wants the rest of the world to sterilize its fiscal spending, its sovereign debt issuance, the dollar needs to become cheaper. And then the rest of the world could purchase it if they want to. Oh, there goes the BRICS conversation. But adjust the time frame. Check back in 10 years to see what the hell is going on with BRICS. All right, let's hit some comments, help you guys out. And that's a Wednesday. Tapsy, Recyclers in the house. Killis is in the house. A pleasure. Critical Mass. Gelds. Dan, can you please talk more about this? The gauges are sensitive. Votes are powerful. Yeah. So you guys saw, I posted on Discord that my vote, I was getting like 80% of the vote rental for TBTC. It was the TBTC, CRV USD, LP, and WETH, I think it was. I don't think it was FRX ETH. But point being, I was like the vast majority of the vote, and it was printing like 20 something percent. And, so it was very powerful. And I have a modest position, a modest CRV position. It's not like, the countless millions of dollars that have been sold, millions of CRV that have been sold OTC of late. So in my experience, in my observation, just, a quantitative observation, the votes are very powerful. I was able to achieve that kind of gauge vote for TBTC that achieved that kind of yield. So imagine it. small companies. Imagine liquidity conditions improve, and instead of, a couple of new protocols come online, you have hundreds of protocols coming online, and they need liquidity financing. They want to do it at in a capital efficient way. The votes are powerful. You don't need much vote weight to get an LP position off the ground. So that's counterintuitive, particularly with regard to like convex votes and cleave votes, because cleave concentrates CVX, so they just have a tremendous amount of curve voting power. So if CRV is so powerful from a gauge perspective, and you can think hundreds of protocols coming online in the coming 5, 10 years, um, it's kind of the inverse expectation I have for the derivative protocols and their how much vote rental, how much capital, capex will be deployed to vote rentals. If you have 96 times the power, one cleave is X amount of CVX is X amount of CRV, and it's like 96X concentrated. You don't need to rent as much. You need to rent much less, a fraction of what you would need to rent from a CRV perspective. So I expect actually the amount deployed to rentals on the concentrated curve LSDs, liquid stake derivatives, to be much less, because you don't need that kind of voting weight to achieve a significant adjustment to the gauges. That was my observation. In the end, we'll see in hindsight. We know what Tetranode thinks, but I think that could be very interesting. In the end, I think it'll all be arbitraged, meaning you'll see vote rentals going to many different protocols over the years. You think it's just going to be Vodium and Vote Market? Um, Come on, give it 5, 10 years. It's going to be competitive. Why? Because you take 1% of the vote rentals. I mean, look at the Warden came online. So where's the next 5 or 10 of those protocols that want 1% of vote rentals for facilitating the capital management associated with organizing the vote rental process, the distribution of capital, the collection of capital, so on and so forth. So it's a business unto itself. So competition, would that not occur? So that's my expectation. I expect I expect some very interesting vote rental things related concepts to emerge over the coming years. Hope that helps. Brian, happy Wednesday. What are your thoughts on the outcome of the FOMC meeting this week? If you did not already cover it, well, Friday we'll see. I'm more interested in like Jackson Hole rather than FOMC, but nothing. It doesn't mean anything. These charts between move and DXY, I get a sense of directionality, and all they're doing is responding to geopolitical considerations, fiscal demand for capital, and Treasury is responsible for fulfilling fiscal uh, capital requirements, and geopolitical complexities, if I didn't mention that. Uh, so they're very much a lagging indicator on the directionality of markets. They merely respond to data, which makes sense. But what they do in their press conferences is just tell a story, and the story is catered to the general public. If you notice, the transcripts are more or less the same, and they're just making small adjustments every time there's an FOMC meeting. So I don't find them interesting. I find that like mainstream media, whether you're watching CNN or Fox, is just broadcasting of a story. They're just going on data. They obviously have significantly more data than the general public has access to, so I don't think they're incompetent in any regards. In fact, I think they make reasonable decisions. Um, but I see the data also, and I prefer looking at my data rather than reading and hearing talking points from politicians and unelected governors of finance. Hope that helps. Friday might provide some insight, though. We'll see what Powell's thinking. Hey, Cap. Bill Clinton's in the house. Happy to catch the stream live and watching the vids when I'm not busy. Hope you're doing well in these dark times. Well, it's volatile times. I like to redefine dark versus good times. Price action volatility. Do we not expect the volatility? I expect this volatility. So I'm not really in a situation where my expectations are deviating from reality. As long as your expectations are reasonable, then you're not going to be disappointed. So I'm not surprised the volatility. I expect more volatility, more downside price action, more horizontal crab action chop and for the next couple of months, 6 months, January. Check back in Q1 2024. I'm most curious not about like trying to buy bottom. I have assets. I own things. I'm very happy to own the things I do. I'm excited to see where bottom is. I'm excited to see the liquidity conditions improve. Who doesn't want to be in the front row seat when that shit occurs? It's not going to zero. It, that, yeah, if you bought some shitcoin, that's not the things that we're interested in here. We've identified core assets that offer credit, FX, financing services, money markets, li- uh, li- um, uh, liquidity facilitators, be it like seamless cross-chain liquidity narrative, like Layer Zero and stuff like Tapioca coming online, and CDPs that are liability printers, which is an extension of credit, but they're printing, dollar-denominated liabilities, stablecoins. These are very systemically significant pieces of infrastructure. Now, the way I've played like stock markets, the equities market over the years, I've had plenty of assets dating back to when I was younger, and I was always small cap. I like small cap mining stocks, and I'm like, my understanding back then, and it really came to be, and what I saw was 10%, 15, 20% of them went bankrupt. They went to zero. But the other ones, the ones that survived, consumed the competition, or partnered and actually got the letters of intent and the deals and the purchase rights of inventory and supply that was going to be produced in the future. So all you need is a few winners over a 5, 10-year time horizon to achieve financial goals. So I expect failures. I wouldn't be surprised if one of the core assets I have fails, but all I need is a couple of them, one or two or three, to survive. And whatever survives into future liquidity favorable conditions, I gotta see. I just gotta see it. I'm just so excited for that. So it might be confusing to many. I'm freaking excited because I look forward to the bottom. There is always a bottom. Part of nature is cyclicality. Liquidity is cyclical, and when the turn comes, I gotta have front row seats. Sergio's in the house. A pleasure. With the possibility of another COVID virus causing lockdowns, do you see more stimulus on the horizon? Uh, I don't want to get too geopolitical. So I see horrible things at the World Economic Forum and the WHO, World Health Organization. It's a lot of totalitarian and systemic control type things. Whole CBDC conversation. There's a lot of internal complexity in the U.S., a lot of dissent. Some great music has come out of it of late. Um, there's and that all reduces from a political perspective to civil unrest. Um, and I've said there's something I said historically. At some point, civility will be financed. If you guys who have been with me for a long time, you remember I said that many years ago. Um, and that's what stimulus is, the financing of civility. I don't really care about its effect on the crypto markets. The crypto markets is a knock-on effect of liquidity conditions. What you want to see is liquidity conditions improve, and then you go with what Raoul Pal talks about is like what the hell outperforms when liquidity conditions improve. Because if you take something like the S&P and divide by US M2, you should really divide by the G7 balance sheets. You'll see that it's gone nowhere since '08. You had nothing. The S&P has kept up with currency expansion. But if you look at QQQ, do I have it here? QQQ divided by M2. You see that tech has done well since '08. So that's a very simple, this is a quick observation. It could get much more granular to inspect more of the liquidity composition from a global perspective, but crypto is off the charts. It's completely vertical. We could look at BTC USD divided by M2. It's vertical. This is divided by M2. So Bitcoin is significantly outperformed or accommodated the capital expansion. It's not the S&P 500, NASDAQ to a degree, but certainly crypto. So the point being, all you need to do well over the next 10 years is remain directionally exposed to capital expansion. And the best expression of, uh, of aligning with capital expansion is the crypto markets. So the question is, what survives? That's it. All you need to do is survive. And what survives will receive a tremendous amount of capital inflow. There's a lot of folks of late, I don't want to digress, I got to end this soon. A lot of folks of late have talked about what's going to best outperform when there's a new bull market, when the liquidity conditions improve. And they're like, oh, it's the new assets. The new assets always do better. If you're comparing to 16 and 17 and earlier cycles, that is not what's coming. What is coming, sure, plenty of new things will do well, and plenty of bullshit shitcoins, tokens that do nothing and are mimetic, so on and so forth. They will go asymmetric and parabolic. Great. I'm not interested in stuff like that. We don't talk about stuff like that. We talk about actual systemic infrastructure that is significant from a financial perspective. Credit, FX, liability printing, so on and so forth. It's meaningful. Remittance and transfers and payment systems. These are meaningful investments. Talking from perspective of an old person that wants to own things that will carry into the future, that offer actual products and services, such as people typically do when they go to the equities market and they want to buy and own a company that offers something to society. I want to own things that are meaningful. And anything that survives, my expectation is going to receive a significant amount of capital inflow because that's Lindy. They're trusted. And what is trusted receives attention because risk is the game that we play and risk management. And something that is trusted will have a reduced risk profile as compared to something that is not trusted. Hope that helps. Drew, where did you learn macro expertise? Not college. I went to school for electrical engineering. My career is Android development, software engineering. I learned macro indirectly understanding what the hell is going on in these crypto markets. And then I'm like, oh, that's what they did back then. And then you just go down the rabbit's hole of understanding post 71 US dollar and follow the macroeconomists and you piece it together. Real Vision's still quality content. I don't really watch it anymore, but I like their content. I like listening to the way Mike Howell talks nowadays. I like listening to Luke. I understand their ideologies, their narratives, their stories, and they all have great points. Got to understand Brent Johnson his milkshake. That's long term. That's the end game. 20 years, 30 years, whatever it comes, but that's end game type scenario. So they all have their place. And the hardest thing for folks to grasp, especially in these crypto markets, is time horizon. Everyone's thinking in terms of weeks and months, and you really got to zoom out to 6 months to year cyclicality. And it takes 2 years, 3 years, 4 years for these cycles to unfold, to see the change in directionality and structure, just like we look at the 10-year and we see the break in structure. Structure is meaningful. Why? Because if it hits the TWAB one, two, three times, everyone coming into the future is like, oh, it's going to hit the TWAB and it's going to go down because that's the expectation. That's the trend. Trend is based on precedence, and the precedence is the cyclical increase in bond price. But this 2020, come on, that in hindsight, now that we're 3 years later, this has all the visual indication of capitulation, a blow off to the downside, and then a swift reversal, and followed by an invalidation of a very historic trend line. A very historic trend line. To the upside. Breach. Trend breach to the upside. So my expectation, just looking at this chart, is the next bull market we see, maybe we see a risk off in equities and bond yields fall to 2 and change. And then we see resistance flip support in the higher high. Trifecta of bullish confluence right there from a bond market perspective. Problem is, look where this little drawing lands us. 29 in these couple of bars right here, 2029. So to understand these cycles, you need to zoom out and look in 5-year increments, 4 or 5 year increments to get a sense of where the hell things are heading. It's not just patience. It's the only way to have this type of patience, where you're looking at things from these long multi-year time horizons, is to get a sense of them and to digest them, and that's the point of why I tell these stories, is to find comfort with these types of time horizons. Um, that's the most important thing, because when you find comfort with them, you're like, all right, this is where it's heading. It's going to take some years, and you sit back and you're like, how much cash do I have? Can I survive a poor liquidity environment, a depreciative environment? So you need cash to survive, and then over the years, a portfolio is going to do what you expect it to do, because you've identified things that survive and that provide actual functional utility from a financial perspective. Hope that helps, Drew. Last two questions, we'll wrap it up for today. Flicium, I can't pronounce it, but hey, Cap, in terms of capital inflow into DeFi projects like Liquidity, why are your thoughts on those kind of CDP? Well, Liquidity is a big deal from an immutable standpoint, and they're developing. I look forward to their new versions of the software. Um, I'm not too fond of the cash flow that LQTY offers, and I don't own any. And I'm more interested in vote rentals with regard to capital efficient liquidity financing. That's been the most lucrative for 2 years. You realize it's going on 2 years. We were setting up this type of structured portfolio, at least I was describing what I was doing in 22, early 22, where we were doing crazy shit in 2021, and then I just like, fuck it. And I concentrated. Everyone knows how I've concentrated on Discord, the stories, and what we talk about nowadays. And it's been doing what it's doing. The cash flow has been there for 22, all of 23. This is actually a good month. It's been a very stable 22 and 23 with regard to cash flow. So now my primary inspection of the portfolio effectiveness is the cash flow. So I'm looking at a cash flow chart. You know, the chart, the waves, the peaks and troughs of cash flow instead of the price point. And the cash flow has been steady, which indicates to me something contrary to price point, that these protocols are very effective and they have systemic significance. They have a reason to survive because people are using the shit out of them. And that's meaningful. Hope that helps. Last question. Drew, what do you think about Frex and Maker buying T-bills? I'm more interested in what Frex is doing as compared to Maker. I think RWAs, real world assets, is it's going to be a big thing in these crypto markets. A lot of folks would argue we should be doing, we want things to be done more with native collateral rather than exogenous meat space collateral. Is what it is. In the end, if you get rid of bias, it's collateral is collateral. Collateral has a price, and in a um, a CDP, collateralized debt position, all right, if the collateral reaches liquidation threshold, it's gone. So that's it. That's the beauty of the sociopathic liquidation regime of these CDPs, designed to protect the system. So there's these systems have survivability written all over it compared to traditional finance and what these banks have done. Collateral is liquidated without hesitation to protect the protocol. And if you protect the protocol, you're protecting all the people that own a piece of the protocol and all the consumers, the other users of the protocol. So you don't have systemic contagion. So that's the directionality. These are the systems that I want to be aligned with. Hope that helps everybody. Wednesday, August 23rd at 12:25 p.m. I appreciate all of you. 22 people made it to the end of the stream. That's pretty cool. 8 likes. Hit that thumbs up button, please. Like and subscribe. Tell everyone to subscribe. In the description is our Discord community, which has seen more active times. But those active times will return. We will see cash flow return. We will see better liquidity conditions and price appreciation. All the shit everyone's expecting. The only question is, what's the time horizon? And we will be here. I will be here doing this stream until that time horizon occurs. So I will see you again on Friday. Thank you all for joining me.